Here's a simple strategy that would have returned 536% more profit than the underlying asset with half the drawdown. And I'm going to give you all the details of the strategy. They're all going to be revealed right now. Nothing left. You're going to understand exactly how this works. My name is Andrew Falde. I have 15 years experience as a funded trader, working with many different types of firms and creating strategies for professionals and individual traders. So thanks for being here. And today I'm going to tell you about a T2 options strategy. And T2 basically just means trend plus trigger. And this isn't the only T2 type of trade. I use it on stocks and futures as well. But this is a T2 options strategy. So today I'm going to show you how to set up the trade, including the charts and the triggers and the trends and all these different things, how to enter, exit, common mistakes to avoid, and the potential for fully automating or outsourcing this trade. So the setup, a few things go into this. And the very first thing we're going to add, which is very simple, is a 200-day exponential moving average. And it's going to look something like this, depending on your platform. So you're going to go to the S&P 500 SPX chart, whatever your ticker symbol is for your platform, and add the 200-day exponential moving average, which is what it looks like here in red, this line. And you can see the reason for that is some of the most volatile crashes and even corrections, some of the most aggressive rallies and most volatile events occur during bearish trends in a very, very simple way to identify and know when you're in a bearish trend is a 200-day moving average. It's not the only way, but it's a very common way to filter out some of those environments. So here are a couple other examples of below the 200 exponential average, some very, very aggressive sell-offs, one here and then not much longer later. So you see, it's not the only time. There's plenty of corrections in here, and that's what we use our short-term trigger for. But a lot of times above 200, you can get choppiness, you can get some sharp corrections, but those sell-offs that never stop, they feel like they're never going to end, happen under those 200 moving average. And so we want to stay out of these types of trades during those conditions. So the second part of the setup is to put an RSI indicator on your chart set to 14-day look back. But the one change you'll make is to set the level to 50. And you may actually have to set two levels because the most platforms, the default is to have a 70 level and a 30 level. And it acts more like an oscillator looking for overbought and oversold conditions. We're actually setting it right across the middle at 50 and treating it more like a confirmation of short-term momentum in the trade. So that'll look like this across the bottom is you have the RSI set to 14, but instead of a line at 70 and a line at 30, because the range is 0 to 100, instead of doing that, we're going to put it at 50. And there's many different signals, a lot of signals in here, but I just want to highlight two of them. You can see that on a short-term basis, again, this is going to help you be out before you even get to the 200 moving average on that correction back to the 200 moving average. So it adds that short-term element to it, okay? So, and for fun, we're talking about an options trade, but I do like to see, like, does the actual directional signal have an edge or some type of smoothness or consistency, or is it attractive in general? So here's 65 years of looking at the S&P 500 signals on whenever the price of the index is above the 200 moving average and the RSI is above 50, you buy. And if either of those are not true, then you sell. And you can see there's a long-term general uptrend in that without a lot of big drop-offs. And any of these types of drop-offs you do see are actually a series of many trades. And those would actually be what we call whipsaw trades, where you have a lot of small losses that kind of accumulate. And here's the great news. When you add options to that, it smooths that out and makes it a better experience. So that's the setup. That's the chart. That's how you see and get the signals for the trade. So now we're going to talk about how to enter this trade. So the entry is when the setup is confirmed. So you have a 200 EMA, the price is above 200 EMA and the RSI is above 50 at 9:45 Eastern the next day, so 15 minutes after the open. That filter or that condition mattered more in the past. Technology and the speed of information, all of that makes it less sensitive. So if you're like, I want to take it sooner. That's fine, as long as you see that pricing and spreads are filled out. There's a bid on every option, so you know the chain is clean. You're good to go. So sell around 2 weeks to expiration, so 14 to 16 days to expiration. Again, this isn't a super sensitive setting. 13 to 17, all of that's going to be good. But we tested 15, allowing for anything from 14 to 16. That's the data. So I'm just sharing with you exactly how this information was accumulated. And you're doing a short put credit spread, and the strikes are a 40 delta on the short and a 10 delta on the long. And I'll tell you, if you're looking at this saying, what are you EMAs, RSIs, DTEs, deltas, minus 0.1, what is all this about? Well, if you don't understand what we're talking about, I have great news for you. I'm going to show you how at edgenavigator.com you're able to learn a lot of these things absolutely free, to understand how to do these types of trades, how to do automated trades, how to do options trades, how to manage a portfolio of signals, all these different things completely for free. All right, so you can go to Edge Navigator and sign up for that totally free. And I'm going to actually show you a shortcut on how to do that here in a little bit. So on the options chain, I know this is really small, but I had to kind of zoom out to show you both of these strikes. But the 40 delta is right here. So that's the one you sell. And then the 10 delta is right there. I barely fit that on the screen, but there it is. All right. That's what the spread looks like if you're visualizing it on a graph, where to the right is up in the index, to the left is down, and this axis is your P&L. So as the market goes up, you'd be profitable, but also as time goes by, you can be profitable as well. Again, if you're looking at this saying this looks like something I should have learned in high school math, great news. It's easier than that, it really is, and it's also more fun because there's dollar signs attached to it. So you can learn a lot about that at edgenavigator.com as well. So that's the entry, that's the setup and entry. Now we're going to talk about the exit. So exiting the T2 on SPX. If the RSI closes at or below the 50 level, or the underlying crosses below or is at the 200 EMA, then again, the next day, you allow that to finalize. There's many times where the RSI can get below 50, and then by the end of the day, it's back above, and then it just continues to take off above that. So you don't want a false exit by taking the trade during the intraday session. So you want to let that close out and do that the next day. It's also very rare for price to get below the 200 without the RSI having already crossed over. But if you're really close to it, it could happen. So if either of those are true, then you would take the exit. The additional is a 99% credit target, which you may think, well, when do you ever get to 99%? Well, you can set that limit. What I've seen, I've tested 98%, 100%, 95, 90, 50, etc. Basically, I've seen every bit you take off of your target profit diminishes the results long term. Okay, feels good in the moment to take that win, but there's so many times you could let it cook a little bit more and get more out of it. But here's the reality: you're rarely going to get there on these signals because there's so many times that it moves up a little bit, comes back, crosses below 50. Some time went by, you take a profit from the trade. That's great. And you're really going to be taking off less than the full credit most of the time anyway. But sometimes it's all about the passage of time, that income that comes from decay of options. And sometimes you can grab that full credit on those big moves, and every bit of those dollars goes toward your end result in a positive way. So common mistakes to avoid. But first, ask you a quick question. Do you want more strategies like this? Would you like to learn strategies totally free? Get all the details, all the rules, the statistics, how to get in, how to manage it, how to exit it. Not just a sales pitch where nothing's left out. You're getting all the details here. Maybe you have additional questions, and that's where a free community comes, or you can ask in the comments. But either way, if you want more strategies, tactical strategies that professionals use in a funded trading environment, then go ahead and like and subscribe this video. Liking it lets YouTube know you want to see more videos like this one, and subscribing will ensure that you get the next video that I post with more strategies. So let's talk about those common mistakes. One is closing too soon. And I don't like to just tell you to not do something and say don't close the trade too soon without proving why. And so I'm going to show you, is it important to not close the trade too soon? Yes. So here on the left is the returns of the allowing any time it comes, the 99 to 100% profit target, really just letting the full credit come in, versus if you were to set a 50% or just, constantly take off when you're only up about half of the credit received. Well, and the end result is 100% less return and 8% more drawdown. The strategy still has a better risk-adjusted return than owning the underlying asset, but it does worse. Okay, and the same thing happens when you drop it to 90% and 80%. It just gets a little bit worse and a little bit worse long term. Okay, so that's what we want to not do. So the second common mistake is not taking the exit. So it's either getting out too quick or not getting out when you're supposed to. And so the question often is like, is it really important? I've heard that options trades, you should put them on, really just let time be your friend and not be trading them. Well, is the exit important? The answer is yes. Look at the extreme volatility that can come into these trades if you don't take the exit. And really, as a comparison side by side, you can see with the exit rules, the drawdowns, the size of them shown in the red arrows here with the normal rules are much smaller than the ones off to the right when you don't take the exit rules. You just put it on and just let time be your friend and don't have a way to manage the trade. So you don't want to do that. So now we're going to talk about the potential for fully automating and why you would even want to consider that or even outsourcing this trade. So automation really solves the biggest challenge in trading, in my opinion, which is the consistent execution of a good edge. Many traders think the challenge is finding a good, reliable edge. But when I interview and I talk to them and I consult with traders, professional and retail, I often find out they know a lot of the good edges. They know a lot of the good trades. But when I get into talking to them about their execution and what they're actually doing with that information, it's very inconsistent. Or I did it for a while and I had a bad month, or I did it and it stopped working. That's their term. Usually it stopped working. And we go back and look and say, well, it's been working since then. It's like, well, it wasn't working then. So you can see it's very difficult. Let me actually go back and show you, like here on one of these equity curves. Yeah, we'll just go with this one is fine. So imagine like this period of time, like you saw that it was doing very well, and then you go through this period of time and say it stopped working. And that would be your opinion and assessment of the situation. Oh, it's doing bad, it's not working. Well, the reality is it's doing just as bad as it did back here, and it's doing just as bad as it did back here. But I didn't really like it, and I found something that was doing better, so I started doing that instead because I can't do all these different things manually. And then what happens? Market tanks. You can barely see it, but the market tanks here in yellow. But you're flat. You can also barely see that. The equity curve goes flat because you stayed out because it was below the 200 moving average. But when things settle out and start going up, you have these implied volatilities super high. You have these massive winning trades that just drive it to new all-time highs. And then same thing. Oh, it's just not working anymore. What happened? New all-time highs. Good strategies require good execution and consistent execution. If you automate, you can allow that at an arm's length and with a passive approach to let it go through all of those choppy periods. Let that happen without you having to manually go through that process, which is very tedious and basically painful. So you can avoid all that. Okay, automation also doesn't just resolve one of the biggest challenges, it adds one of the biggest benefits and edges in trading and investing when you automate, which is to give you broad diversification in strategies, assets, and timeframes. You basically can become superhuman when you add automation to your trading because you can see all of these different timeframes and watch 10, 100, 200, 1,000 different stock charts, ticker symbols, indexes, options trades all at once, every 5 minutes, hour, day, whatever it is. There's no way you could consistently and accurately do that by hand. And all the different time frames, having to switch from one time frame to the next and remember all of the rules and the details and the sizing parameters, it's nearly impossible. But there's so much benefit to diversification and having strategies like this one, which is mostly bullish, but also has an income component to it. And there's so many other strategies for market neutral and bearish and high beta that when you add them all together, you get the best result. So if you want to learn how to automate options and the many different ways to do that, go to edgenavigator.com/free. And in just 1 second, if you stick to the end, I'm also going to tell you the platform I use to do this study with automation as well. So finally, the outsourcing, before we get into that, finally, that outsourcing component that I talked about related to automation and outsourcing. If you're just like, yeah, definitely, I don't really think I can do this manually. I'm going to second guess, or I'm going to get tired of it, or I just don't have time, or I have too many other things going on, or I already trade all these other things manually. There's no way I would do that. And I also don't really have time to learn automation. I know, it's going to save me a lot of time and give me a lot of benefits, but I just don't even have time for that. I just really am, working 25 hours a day, 8 days a week, and I just don't have time for anything else. Then that's where outsourcing could come in. So if you join our community, you reach out to me in there and you mention your situation or what you're looking for, then you can have the opportunity to outsource complex strategies and automated systems. And I can connect you to the right person and we can talk about what that might look like. All right. So again, you do that at edgenavigator.com, or you can take the shortcut to edgenavigator.com/free. So in summary for this video, the T2 method is applicable to options income spreads. And as we've seen, this is not a very complex trade. To some who are very new to options trades and technical analysis and indicators and such, it might feel a little complicated, but there's really only 3 real factors involved here: trend, trigger, and options trade. And it's not super complex. So simple strategies can generate higher return with less drawdown. That's really what we're looking at. It's really basically the definition of having an edge. So I want to thank you, first of all, you for watching, being here, liking the video, subscribing, joining us for free at edgenavigator.com. But also thanks to Delta Ray and their product Mesosim, which is what I used to create the graphs you saw, the statistics, the trades, the analysis, the comparison of using one rule versus the next. That type of, without these tools, stuff like this, it would take me months and months just to get one version of the study done. And comparing another one would just take even longer. So because of great tools like this that Delta Ray has built, you're able to get this information faster. And also, I can show you how to get a $60 discount when you join the free community at edgenavigator.com/free. So thank you for watching. Like the video, subscribe, leave a comment if you have any direct questions or feedback, or you have a question or idea that you would like me to study in the future and share with you. I'd be happy to do that as well. All right. Until then, talk to you later.